Stephen Byrd is here. He's an equity analyst at Morgan Stanley. Stephen, it's good to see you. Welcome.
Thank you for having me.
And, you know, the reason why we all are a little bit cautious on new energy is because of the yieldco type companies, which are exactly the ones that you're saying, look, this is not where you'd be going right now. NextEra often comes up, Clearway Energy, for instance, a few of those other players. So why do you think these see most vulnerability in the market, and where do you think people should be looking instead?
Yeah, you know, yieldcos, the fundamental business model is driven by buying an asset at a certain yield and then financing that asset at a significantly lower yield. And so we're looking essentially at that spread, and that's really driving the valuation, it's driving the dividend growth for those companies. The concern that's fairly obvious is the cost of financing is quite uncertain right now. If the cost rises, we're really not sure that they'll be able to maintain that spread, which is so critical, not just to the yield today, but to the growth tomorrow. So companies like that are essentially centralized around the cost of financing concern us more than, say, companies that are really developing projects, building projects, or manufacturers that have a lot less exposure to financing at all.
Okay, really good explanation. And that's why we can see this characteristic pop up in different industries, but here especially where people might be trying to take advantage of that spread. So where do you think conditions, financial conditions especially, look a little more favorable?
You know, for some companies that just have very little financing needs, those are the simplest. A few equipment makers in the clean energy world that are in really good shape. An example would be Bloom Energy. They are well financed. It's a relatively capital light fuel cell model. This is also, we think, a year that they're going to be really breakout in terms of significant EBITDA. So very exciting, minimal financing requirements. And then we think about really big finance companies, development companies like Sunrun and NextEra, the parent, interestingly enough, AES. These are companies that are very big. They have better pricing power. They have excellent access to capital. They often have a large number of banks in their syndicates. And those companies we think are going to be well set in terms of both raising capital, and you raised a good point about the data point this week on financing. And also when we think about pricing power, many of these companies do have quite a bit of pricing power. Right. An example of that dynamic would be Sunrun in California. Sunrun will go to a homeowner and will show the pricing of their product compared to the utility bill. In Northern California, the utility bill is above 30 cents a kilowatt hour. Sunrun's pricing is around 20 cents a kilowatt hour, and that's with no capital upfront to consumers. So unlike many products, this is truly a deflationary product. Sunrun does have the ability to increase their pricing if necessary, if their financing costs were to rise.
And you talk about those residential rooftop installers, and while they are certainly the leaders, it is still very much a fragmented market. So I guess in terms of the lasting impacts of the fallout from SVB, do you think we'll see more consolidation from those smaller companies that might not be able to access the debt market?
I think that's an excellent point. We are concerned about the smaller players and their access to capital. As you pointed out rightly, Silicon Valley Bank has been involved in finance, often to these small developers. So this could result in consolidation. I think that just speaks to the strength of the larger business models. Those business models also have a number of operational and finance efficiencies that the smaller players just don't have. So yes, I would expect to see some consolidation. And
final word, Stephen, what happens? So we see now the 10-year yield is actually dropping. If the Fed actually starts cutting rates by the end of the year, what then?
Yeah, what that might mean, we've been thinking a lot about that. Recent data points, and who knows where it goes from here, of course, but data points indicate that the credit spread essentially is serving to offset the drop in yield. I would expect that dynamic to stick around in clean energy finance. That said, the quality of the underlying assets is extremely good. The performance of these assets financially, operationally, has been really quite good. So I do agree with the earlier point that there is enduring interest in providing capital to the sector. The sector projects are still quite high quality. Whether the cost of capital falls, I don't know. But frankly, at this point, given the fall last week, investors have been much more concerned about a dramatic increase in financing. Right. So I would be quite happy if the cost of financing stayed relatively flat. That would be at this point a victory, and we'd see a lot of upside in our stocks.
Right, or perhaps by the time we actually get rate cuts, their cost of financing is so much higher anyway for secular reasons that off we go. It's great to have you here today, Stephen. Thanks for your time.